Hello, this is Craig Larson with Larson Financial Advisors for the Market Minute on March 27th, 2019. So today I'm going to talk about a couple things, a replay of the last 4 months of the stock market and why these things have been so volatile. And then secondly, the inverted yield curve, which has just occurred as of last week. Number one, the replay of the stock market and why there was such a huge downturn and a quick rebound is almost entirely due to central banks. I know you've probably been hearing about tariffs and Brexit and things like that, and they're meaningful, but the central bank action has been the key driver to stock market behavior. So what happened was, as you know, interest rates have been rising over the last year or so, and the central bank has been kind of consistently raising the rate of overnight lending, and then also tapering off on government bond purchases. The market had become more and more concerned about that. And then in the fourth quarter, as Jerome Powell at the Federal Reserve said, we are absolutely going to keep raising rates, and here's our aggressive schedule, and we are absolutely going to continue tapering. The market freaked out, okay? Why did it freak out? Well, the market has become addicted to quantitative easing. It's been addicted to low interest rates that have been artificially held down, and it's been addicted to the huge amount of bond purchases that have happened that basically provide energy, caffeine, into the financial system and caused stocks and real estate to go up. And the threat of that being completely taken away freaked out the stock market and caused a 20% drop in just a matter of a couple of months. Okay, worst December since 1931 or 32. Then, right after Christmas, Jerome Powell and the Federal Reserve Bank announced that, whoa, we've changed our mind and we are not going to, raise rates. We're going to hold for now, and maybe we even reduce them or lower them if we need to. And we're not going to taper off on bond purchases. And by the way, we could open up quantitative easing and start doing huge bond purchases again. And the market loved it, just like a drug addict got high again from that, and we had the best January since 1987. So this should tell us as investors that the market is highly dependent on central bank actions, and at the point that they can't do quantitative easing or lower rates, or at the point where it just ceases to function and work well, this market will be in trouble. So I couldn't tell you when that is or how that's all going to unfold, just that we need to have a plan of action to adapt our portfolios to that eventuality. Now, the second thing, the more recent thing that's happened, is the inverted yield curve. And what that means to people that are not involved in banking is typically the farther out you go on bond maturities, the higher the rate of interest. So usually the overnight rate's the lowest, and the 2-year bond's higher, and the 5-year bond is higher than that, and 10, 20, 30-year bonds are higher than that, etc. And when the yield curve inverts, it means that short-term rates are actually higher than longer-term rates. And what happened last week was the 3-month rate became higher than the 10-year bond rate, a little bit, okay? And so for a lot of pundits, they'll say, ooh, this is a sign of a recession. And I will tell you this, in studying the probabilities of this, it is a high probability signal. A recession does not necessarily have to follow this. It doesn't always follow this, but it often will. The other yield curve, other pundits would say, nah, 3 months over 10 years is not meaningless. We look at the 2-year bond over the 10-year bond, and that has not yet inverted, but it's getting very, very close. So why would anybody care about this? Again, it has to do with recessions. And when the US economy goes into a recession, the average stock market drop is 40%. Okay, so that can be meaningful to investors, obviously. If you're 30 years old, you probably think, great, drop 40%, and your portfolio is probably not very big. It takes a little bit of a hit, but you're dollar cost averaging and you're adding to that thing. So that's good news. If you're 55, 60 years old, this should concern you because now your portfolio is probably much bigger. If your $1 million stock portfolio takes a hit, you could lose $500,000 in the next recession or potentially more. And you just don't have time to recover. So that's a different kind of a plan, and that portfolio should be strongly building up a risk management plan or an exit strategy now for the eventuality. So I don't know if these things are going to trigger a recession. but we've gotten a signal. It just puts us on alert a little bit more. So if you don't have a plan or you're not sure how to adapt a portfolio to that, please give me a call or email me, and I'd be glad to discuss that with you. Have a great day, and I'll be back in a few weeks for the next update.